Hello, hello. Welcome to episode 30 of the Golden Question podcast. In today's episode, I'm going to be answering the question: what are the consequences to a debt based economy? And so, what I'm alluding to is the idea that debt is a necessary factor in economic growth and in a capitalist society. Something that some people need to know and they sort of undermine it is how prevalent debt is in today's society and in particular the economy. I've watched a sit down with Robert Kiyosaki and Donald Trump, and they were discussing, this was back I think in 08 09, and they were discussing how important it is for someone to use debt but to use it wisely. And I think that's the sentiment that is widely accepted in society today, even by free market people and Austrian economists, um, and everybody in the business field. They believe that debt can be used, right? They call it a double edged sword. It can be used for good and it can also be used for harm. And so it can help you grow your wealth, it can help build wealth, but it can also destroy wealth. For me, the parallels aren't there. And what I mean by that is when you factor in what constitutes a functioning economy, what makes an economy wealthy, right? If you look at Adam Smith's book, right, The Wealth of Nations, he focuses on the production of goods. That is what makes an economy wealthy, right? The idea of somebody taking some of their excess production, right? If I make bread, this is just me surviving off my own produce. And if I have some excess bread, I can go ahead and sell that. And in order for me to have that excess bread, I need to have some savings, and I could save some of my excess bread in order to sell it. And that's really what kickstarts an economy. That's what grows an economy. People have excess of whatever they are producing. And in that, they save their excess, they store it so that they can sell it later rather than just consuming everything they produce. They sort of store some of it and save it for resale. And that really builds the economy. But you can see it starts off fundamentally from the production of goods, the manufacturing of goods. And if we look back into the turn of the 20th century or the turn of the 19th into the 20th century, it was all based on production, right? You had tremendous amounts of wealth created by the production and mass production of goods. Services sort of took a second seat. It wasn't as, um, it wasn't as lucrative, but the production of goods is what really kickstarted off the wealth of many individuals, and in this case, the wealth of the United States as a whole, and what made it a prominent powerhouse in that respect. Now, debt had nothing in that equation for the creation of wealth in the United States. Debt wasn't a factor until the Federal Reserve came in. And with the creation of the Federal Reserve and the sort of normalization of this fractional reserve banking system that we saw emerge, that's when the idea of debt started to get promulgated. And even in the start, debt was still seen as something bad. It was still seen as a sin, was still seen as something evil, something that somebody should avoid. And it was always tied to negative things about someone, right? It's always someone who drank a lot, who was on drugs, was homeless, and so they used that to help, in an illusion to help uh, get themselves up back on their feet. But also, somebody who was successful and ended up using debt, they eventually got back down to that state. And so debt always had this negative connotation with it. But with over time and with the, I guess, the propaganda that is of the federal government and its domination into banks and many large scale businesses, debt the view on debt started to change and to shift, from a clearly negative stance to a more neutral stance. And that neutral stance was, yeah, you know, you could use debt, and especially with the continuation of Keynesian economics that we've seen, especially in the 70s, this mass consumption, that was again promulgated by debt, right? This idea of the credit card started to emerge. This was all based on debt and this sort of normalization in society culturally, also on the acceptance of debt. And what did we see, right? We saw the United States shift from that, that strong manufacturing base to, more of the services industry. And the United States shifted a bit, from what made it wealthy to begin with, right? If it ain't broke, don't fix it. So if manufacturing is what made the United States so wealthy, one would question why they're shifting away from that source of wealth creation and that prosperity. Now you have to ask yourself, what enabled this? And I would argue it is the fractional reserve banking. It is the uh, the deviation away from the use of gold and the use of real money. And so when we started to use Federal Reserve notes, IOUs, this fake money, this paper money, this wealth that's created out of thin air, that's when the idea of debt starts to become incentivized. Because when you think about it, debt at a fundamental level is the creation of money. Let's say, for example, I currently do not have money. I did not produce any goods and services in society for me to, in return, receive any wealth. And so, if I go ahead and go borrow money in an ideal economy, if I were to do that, nobody would lend me money unless it's a close friend or a neighbor or a family member that, I say I need some help. Can you lend me some money? And in that scenario, I would just lend them back the money, right? No family member would demand that I pay them back plus interest. And so debt is sort of, initially it's just a way to help someone, help a family member, help a neighbor, help a friend, a close friend. And you end up giving them something. If they don't pay you back, it's not the end of the world. But if they do pay you back, at least they give you back a little bit, or even, it'll be nice if they can give you back the entire thing. But if you're just going to give a random stranger some wealth, somebody who you've never seen before, across the country, and then expect them to pay you back, this idea in the past is unheard of. But again, because we've had the Federal Reserve create bank reserves, this is what eventually followed suit. And that is this large scale debt machine, and this entire debt economy started to emerge. You have the Federal Reserve pouring reserves into banks, and these banks are started to transition from their original purposes, their original goals, which is purely to store your wealth, and to make sure it's safe, right? Because again, people were storing real money, real wealth. And so the bank promised to secure that wealth and to store it. And it was essentially providing a service. And so instead of me storing my wealth at my house and having to protect for it myself, I could just stockpile it with a bank. However, the purposes of the bank started to transition, and it did transition naturally. Banks did start to slowly but surely, start introducing fractional reserve banking. But instead of the market correcting itself and going back to the original sense of banking, what banking originally was, instead of the market correcting itself from that normal human behavior for banks to get greedy and try to promise returns to your average individual citizens who were thinking that they're going to the bank is holding their money in a safe, and when they demand that money, the bank just pulls it out and gives it to them. The market was going on a trajectory where it was correcting these mistakes. However, the Fed and the federal government did not allow that to happen. They actually encouraged that behavior. They rewarded that behavior because now the banks are no longer held liable, and their reputation is no longer at stake if they fail to fulfill their promise in holding the reserves of their depositors, holding their deposits, and doing what a bank traditionally does, which is just to secure the funds of their depositors. And when the banks failed in that regard, the federal government rewarded them. They said, you know what, you don't even have to worry about securing the funds of your depositors. We'll do that for you in a way. You can go ahead and take your funds that you receive from depositors and you can make your own investments. And if you fail on those investments, who cares? We'll just fill you back up with some reserves. And in the event that you really go bust and make really bad investments and you put your whole business at stake, don't worry, those depositors, we've got them covered with the FDIC. And so what you see here is the government rewarding bad behavior, creating this moral hazard to begin with, and encouraging banks to gamble, encouraging banks to be, to make even riskier investments. Because you could see what'll happen here is once the banks realize that they're not really using their own money, right? If the banks were actually using their own profits to make investments, that's fine. Right, in a traditional banking system, the bank makes profits by the fees that they issue for people securing their deposits with the bank. And then the bank can use those fees, right? They're just ordinary income that the bank can then reinvest in the company, in the bank itself. But as you could see, once you spend money that isn't yours, that you personally did not work hard for, you tend to not spend it wisely. And this is the problem. This is what warps the economy. Because ultimately, an economy traditionally is based on people using their wealth, using the savings that they've worked hard for, right? Going back to the original example, if I'm baking bread and I'm really good at baking bread, I can bake bread for myself. However, I ended up baking some extra. That extra baked bread that I made, I actually worked hard for it. And so now when it's time to trade with other individuals, I'm going to trade wisely. I'm going to make sure that I trade for something that I really want and something that is actually worth the bread that I made. However, if somebody came up to me and just handed me some extra loaves of bread for free, or in other words, if I went out there and steal them from someone, and in fact, stealing actually, even stealing requires a little bit of effort and work. But if, let's say, if somebody were to just hand me some bread, then I don't really care how I spend it. There is no consequence there. I didn't actually work hard for it. So I could spend it however I want. I can buy things that I don't necessarily need. And right there, it warps the economy, right? It warps the demand. It pulls demands into different areas of the economy that normally wouldn't be in demand. And so this is why I think I consider debt a sin, is that it encourages you to act in sinful actions, right? Going, doing things that are sinful, doing things that are illegal, doing things that normally wouldn't have demand, but they do have demand because you have now acquired wealth without actually working hard for it, without actually rolling up your sleeves, without actually sweating for it. And this idea of earning wealth honestly is very prevalent in Islamic tradition, specifically. Right, we call it halal money. Right, it's money that you worked for, you earned it honestly. If there's money that you found on the street, we consider it not halal money. A lot of people tend to justify it and say, "Hey, it's God giving me this money. I found it. I got lucky." But if at the end of the day, if you did not work hard for your money, um, it's sort of bad money, and that you have to put it away. You have to give it to charity. And so you could it makes sense in a normal free market economy where demand again dictates a lot of the times where resources get allocated in the economy. And so when that demand is artificial, you start seeing warps, you start seeing malinvestments. And this again is started to take place with the creation and normalization of debt in society. And so going back to the history of banking, you have banks now who removed a somewhat market regulation. And again, this idea of market regulations is something that really confuses people because a lot of the times, um, people who call themselves capitalists, who call themselves free market proponents, they are perceived in a way that they're against regulations. Well, it depends on what types of regulations. If it's government regulations, they're against, and we're against because that regulation is being administered by gunpoint. We would much rather prefer free market regulations, which are naturally created in an economy. And one example is for someone to have an a vested interest in the depositors and their funds. And so when the government removes that market regulation where, hey, if you make bad investments, we got these depositors covered, now you see a malinvestment. Now you have banks that take their depositors' money and invest that money. And we've seen this in the '08 where they started to issue more mortgages than usual, right? So they took all these extra reserves and they created this bubble. And you could see other bubbles, right? In the '90s, you've had the tech bubble. And you always see these pockets of bubbles that emerge throughout time. And this is because you have areas of the economy that get overvalued. And why do they get overvalued? Because there's excess demand for those goods and services. And why is there excess demand? Where is this demand coming from, right? Money is just prices and money is just another form of demand. Where is all this coming from? It's coming from the Federal Reserve, because ultimately it's backing everything. It's filling up the reserves of these banks, and B, it's coming from the depositors. It's coming from people who put money into banks thinking that the bank is simply holding their money, in a safe in a back room. But instead, the moment you give money to the bank, first of all, the money itself is an IOU. But the moment you give money to the bank, that's it. It's gone. Your safe is still empty in the bank. It's just when the bank shows you how much money they owe you, right? It's not your money yet. They just show you how much they owe you. And so when you demand for money, that's when they just peel it up from the reserve, which again, how do they get their reserves? It is from the Federal Reserve. But the moment you've given your money to the bank, the bank has already invested in your money. And do they care about what investments they make? No. There is no incentive for them to make good investments with your money because ultimately the reserves in the bank get filled by the central bank. And again, all of this was debated back at the turn of the century when we wanted to have a central bank. Once people like Alexander Hamilton and Andrew Jackson and many other people were heavily debating on whether or not the United States should have a central bank. And one side was, yeah, we should be able to not allow people to lose their money. But they hadn't considered, again, this is all new because we've never had something like this before, but they didn't take into consideration what would happen if we were to let things fail initially and let the market correct. And so ultimately they were worse off in the long run because even if you let people's money get backed up by something, right? Even if I put my money into the bank and let's say the bank makes a bad investment and I get replenished by the Federal Reserve, that money that has now been replenished is not the same money that I initially put in. The money that the Fed prints and gives me back in return is of lower value than the money that I had put in. Why? Because of inflation, right? By de facto, when the federal government prints new money, you're creating inflation. And so the dollars that I get from the Federal Reserve after it after the bank goes bust and it makes bad investments and my money goes away right away. Let's say I lost $100, the $100 that the Fed now prints up and gives me is worth less, and so I am actually worse off than if I had just let the bank lose my money, and then in the future, banks could then realize that their reputation is at stake, and then they'll transition back into a more traditional banking system. And so, what do we have right now? Because we've let this system promulgate, our entire economy right now is addicted to debt. Right? It's like a cancer, right? You initially give it an excuse to grow, and then it just continues to spread and spread and spread until it consumes everything. And so I wish I can go back in time and tell, the individuals who were first proponents of having a central bank and um, having this engine of credit, backed up by just thin air, right? The creation of credit. I wish I could go back to them and tell them that, your attempts at trying to solve a problem will eventually engulf into a bigger problem, a problem that is now the entire economy. Right now, the entire economy is a problem from the debt. And so the entire economy right now is built on debt, right? The Fed right now is essentially providing all the demand that we see in the economy, right? Initially, demand is emerged from people who work hard, people who actually work for their money, but essentially today, a lot of the jobs that people work, their productivity is not equal to what they get paid, and what they get paid is a lot more than their productivity. Now, you might ask, how does a business pay you more than what your productivity is worth? Well, A, inflation, and B, the Fed again is also borrowing money. It's consuming debt, and it's leveraging. And where is the bank getting the money that is borrowing? It's getting it from a bank. And now where does the bank get its reserves? The bank eventually gets its reserves from the Federal Reserve. And so if you track back all the wealth, a lot of this money, if you track it back to its source is the Federal Reserve. And so you have this entire economy that's hinged on the Federal Reserve, right? There is no longer, or there's a very small portion of the real economy in which you have the creation of wealth through the creation of goods and services. That's a very small portion of our economy. Most of our economy is, what people call a zombie economy. It's a dead economy that's just being, shocked temporarily into life. It's sort of like, a corpse, right? A dead person who you just electrocute, and for a second their eyes flicker, their hands start to shake, and it looks like it's alive, but remove the electricity, and the person's still dead. So 80% of our economy right now is all dead, but it's being kept alive by this cheap money, by this debt, by the creation of credit. We have a very small portion of the economy that is actually real, right? That is actually what an economy is supposed to be, right? The creation of wealth through the creation of goods and services that benefit society. And as I said before, you could sort of look at it in terms of inflation, right? You have the actual value of something, and then you have all this inflated wealth, this inflated price that makes the item priced higher. And so this is where you could really apply inflation to the entire economy. And that's why I think inflation is a lot higher than 4%. But if you look at, let's say, a real estate, right? The price of a house. You could say the real value of that house is 100,000. That's what the house is actually worth, right? If you factor in a profit margin, um, add in all the costs at their original value, let's say the house is 25,000. But because of all this inflation and this creation of credit, it has enabled the house to now, to have an asking price of, let's say, $1 million, $2 million. And so you could see that 25,000 is part of the real economy, and everything else is just zombie. It's just fake. It's just, the creation of credit. And so if I were to buy that house, I'm exchanging 25,000 of the real economy alongside the rest, which is all just creation. It's all money printed from the Fed. So if you look at all the dollars in the entire economy, a very small portion of it are actually created honestly through the creation of goods and services. And the rest is just created from thin air. And remember, you have to factor in the creation of goods and services and the price that I'm asking for those goods and services. So you might say, wait a second, there's a lot of goods and services being produced in the United States. But again, you have to remember the price of those goods and services are inflated. So you have to take that into account as well. So, right, Apple's costing $40, but if you look at their real value, their true value, you could say it's more like 25 cents. But again, you have to factor in that inflated price, that credit that's factored in, that, you can even call it the dead price. It's all the inflated part of the price of the value. And you look into cars, right? Cars right now, they could go for 90,000. So you might say, hey, if somebody buys a car for 90,000, they're exchanging 90,000 of the labor and include a profit margin and all the costs for 90,000. So that's real. That's part of the real economy. I would argue it's not, right? The car in and of itself is only worth 10,000, 15,000. And then you might say, well, the costs are more than that. Well, the costs themselves are also inflated. So if you take into account and you bring it down to a real level, I'm actually only paying 10,000 for that car, but that rest 80,000 is all part of this fake price, this inflated price. And so we have that all over the economy, right? We have a very small portion of the economy that's actually being traded and operated realistically. I think that's a better term. It's the real economy that's being transacted realistically, and then you have everything else as an aggregate, completely a creation of the Fed. And really, that's what the consequences of this fractional reserve banking, this normalization of debt as a result, and the collusion of government now working with the central bank and helping keep the system alive, or should I say, dead. Thanks for listening. As always, stay safe.